Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this May 28th after markets have closed, to talk with you a little bit about what's going on from our lens, how we see the conditions and the landscape that make up the markets and the economy. Allow us to share our screen and get right to it. These are reasons to expect this more sticky inflation scenario. And with that comes implications for investors, higher for longer interest rates, which would suggest perhaps an investment playbook that's very different from the, throw a dart against the passive investment wall and find something momentum based and you run with it. We think those days are coming to a close or have closed. And to that end, we believe that the wind is no longer at investors' backs. We have to be more active, more proactive. You got to know what you own, why you own it, do the homework. And this is how we navigate these waters. This chart is a perfect depiction of what we expect this new regime to look like. As you could see, from 1945 to 1982, this post-World War II period. Well, think about it. We just came off of a victory around ending the World War II, and the United States was rebuilding and spending, and households were spending, and suburbia was created, and new homes and the costs that are involved in the consumption of the 1960s and the consumer growth there. Inflation got very sticky and got moving along in the 70s and then went hyper in the mid to late 70s, early 80s. And that's where we are. That's where, that was that 1982 period I mentioned earlier. But over that period, interest rates went up, as you could see from the graph. But look what the S&P 500 did, about 5.7% annually. Interestingly, when you look at the other side of the graph, when interest rates went down for the next 40 years, look what the S&P 500 did, double. So it goes to show you when interest rates come down, it becomes a lot easier to make money in the S&P 500. This is what this is showing us. We believe that now we're on the other side of this, and we're likely to see a more difficult equity market, one which we believe that we have the right prescription and playbook for. But before we go there, let's talk a little bit about what this year, the balance of this year, looks like. It's been a wild one, right? We've had tariffs, we've had a lot of ups and downs along the way. The new administration is going at it in full force, and while it could be exciting, it could also be disconcerting. This is a graph that shows you the employment of 7 very well-known companies. We're not showing the names of those companies, but you could guess what they are, and the employment of them, and you could see how the employment has fallen off of a cliff. That's interesting to us because it shows that maybe there is a point to which some of these high growth technology companies are less likely to need workers. The other thing is, the fiscal stimulus question mark, right? So maybe we're likely to see less stimulus as the government is retrenching and pulling back from spending. And that's a big deal. And then, of course, what impact will this have on the consumer? Can the U.S. consumer stay healthy and continue to sort of carry the water for the fiscal side of the economy? We have to wait to see how that looks. So again, our playbook: respect volatility. Cash is not trash anymore. Cash is paying a good return. It's riskless. It only goes up. It doesn't go down, and it has the optionality value of being put to work instantly. So we're favoring overweighting cash in our portfolios, underweighting or fixed income. That is not the balance. Again, we think interest rates trend higher, so therefore we're less likely to have a substantial weighting in fixed income. Dividend growth, value style, free cash flow yields, high free cash flow yields. This is where we see opportunity and lots of it. So that's an area that we've been focusing on, as have we been focusing on in the international sector. You've heard me talk about this. You'll see some slides in a moment about the international sector being so damn cheap that we couldn't ignore it. And fortunately, we didn't ignore it, and it helped our clients navigate 2025 very well so far. So let's talk about valuations, because that's the lodestar of the work we do. It's been shown in study, in academic study for years now, that the number one determinant for the long-term success of an investment portfolio, long-term being 7 years or more, the number one factor, it's not who's in the White House, not who has Congress, it's not growth of earnings. It's one thing. It's the price you pay when you enter the investment. That is the biggest determinant for growth over the long term. Over the short term, it's a thousand different permutations, basically noise, depending on what's going on at that particular time. But over time, as the old quip says, is over time, the market is like a weighing machine. Short term, it's like a voting machine where everybody's input makes a difference. But over the longer term, it is a weighing machine. So we proceed on valuations. Now, this is a heat map that will show you why we're concerned. As you can see, the United States and every measure of valuation is in the red. From dividend yield to the cyclically adjusted PE ratio, CAPE, forward PE, trailing PE, price to book, all hot. However, if you look down below, emerging markets, UK, Europe, even in Japan to some extent, there's pockets of green and yellow. So this is why we've been talking for a while now about international markets. This is a slide that speaks to one metric that is used on occasion. It's called the price to sales multiple. And your price of your investment divided by the sales, not the earnings, the sales. And what this is showing us is that in what was this? I guess it was 2020 or so, before the COVID-19, the price to sales was 20x. And then it came down, obviously, with the COVID and such, and then it went right back up again. This is the number, the market cap of stocks with price to sales greater than 20. Folks, price of sales multiple greater than 20 is insane. You cannot fundamentally digest that. There was a very important comment made right before right after the dot-com crisis in 2000, when the CEO of Sun Microsystems went out in the public sphere and talked about what analysts were thinking prior to the dot-com crash, what analysts were thinking in having his stock as high as it was at 10 times sales. He thought that was insane, and he went through a whole thesis on why that was insane. It's impossible for the CEO to rationalize that. He wouldn't have been able. It didn't make sense to him. And now we're talking about 20 times. This is the froth that we've been seeing in certain segments of the market. Here we talk about valuations and future returns. Remember, this is the concept that valuations do make a difference. The price you pay for an investment is a major determinant to your success. And what this is looking at is that when you have a PE, this is a CAPE. This is Robert Shiller, Nobel Prize winning professor at Yale, who developed CAPE, cyclically adjusted PE. I want you to think about it as a smoothing over time of the earnings. So the earnings go like this, but with CAPE, they smooth it. They can average over 10 years. So it's a more of a softer measure, if you will see, maybe you could even argue a more accurate number over time. But what this will show you is that when you use this cyclically adjusted PE ratio and you have one that's sort of, you know, below 14, let's call it, um, you're getting good returns. They're 15 respective, 8.5. As you get north of 21, 28, this is price to earnings, not price to sales, price to earnings. You obviously your forward returns, 10-year forward returns are a lot less. Price matters. Let's not forget that, folks. That's why we do so much work to get the valuation stuff right. It makes a difference. And here again, the same scenario. S&P forward PE ratios as a subsequent 1-year return. And you can see here that when you look 1 year forward, when you have a, a PE in the 20s, many of your returns are below zero, right? If you look at the ones over here, these are returns that are above zero, and a lot of them, and these are less than 20 PE the forward year. If you go out 10 years, wow. I mean, it's stark, right? You want to be in this zone of say of less than 16 times earnings. So important stuff. Okay, on the opportunities. Overdue, I call this slide overdue. Look what we see here. This is a chart that shows you where the returns were for each given year, what country or nation, area of the world. And as you can see after the dot-com crash, the emerging markets led the way. And during this period, the United States wasn't doing very much because our market was flat for almost 10 years. But then comes the great financial crisis, and the United States comes out of it faster than most, and the emerging and the UK and Japan and Europe don't do as well. But what exceptionalism, what an amazing run it had been for the United States over those periods. We were the first to reduce interest rates aggressively. We were the first to come out of that, and quantitative easing and all in those days. So the idea from this, it may be regression to the mean, right? What's up for a period comes down. What's down for a period comes up. You could see the implications. This is more of a relative performance number, and it could show you here again the outperformance of the United States markets versus the European or EFA index over the last 15 years. Stark. And that has, folks like me and us, sort of interested because it allows us to look at where others aren't looking. This is again back to our US cyclically adjusted PE ratio. And you can see that here's the MSCI US and here's everybody else, ROW, rest of the world. And you can see the massive gap between this PE. Here again, we have a canary in the coal mine because here we're saying demand jumps for funds stripping out US stocks. So it's beginning. The investing world is sort of thinking maybe it's time for us to have less US exposure. And this is what this says, is that this is why we're seeing more money flowing into ex-US funds. Intriguing. And by the way, it's working because the United States markets, the S&P, has not done as well as the international market so far this year. We still see opportunity in the international markets. Here's EFA, and it shows this is again is the median Shiller or CAPE PE, and you can see it's still fairly cheap relative to its average. And I think you'll see the same thing versus emerging markets and the United States. Emerging markets have really come down to an opportunity where, to where they very well may be an opportunity. So again, with valuation, it's not short term, folks. It's more of an over period of time. But hey, we're not in the business of being short term investors. We're in the business of compounding wealth over time and minimizing drawdowns. I threw this slide in there because I want to talk a little bit about Japan. I think Japan is intriguing right now. It has had, as you may know, many decades worth of flatness, if not down. Oh, here's a good example. The Japan CAGR was 0.77% over the last 30 years. I mean, that's just awful. Compared it with China, that grew at 8.4% a year. So we believe that the tables are now switching where we could start seeing Japan outperforming. So keep an eye on Japan. Thank you for your time. Appreciate the attention. We're always looking forward to chatting with our clients. If there's any questions you might have about your portfolio or a question about how we are sort of looking at markets at this current point, or you want to review your financial plan or estate plan, please let us know. We're here to help. Thanks very much. Have a great week.